It's 11 o'clock. Let's get going, I think. So I've got a couple of bits of news to look at this morning, and then Andrew Mahatchi is going to run through what happened over November. And our guest this week is Rhys Davies, who's the manager of Invesco Bond Income Plus. I remember we were talking about the increased attraction of bond funds last week, so I think it's just actually quite timely. So without further ado, just want to talk a little bit about Chrysalis, because they've been publishing a bunch of stuff in the last few days, and they had a Capital Markets Day the other day, and also Syncona, because it's done a couple of deals. Chrysalis first. So, I mean, we know the story on this. The NAV and the share price marched up, and then they marched all the way back down again. And the interesting thing, I suppose, for investors is this little turn here. So it does look like we are, well, we are off the bottom, in fact, by quite some margin now. So those sort of touched less than 51p, I think, at one point, and we're now up to about 72.5, something like that, but still on really quite significant discount. So the last NAV that they published was 147.79. So this, yeah, really is quite chunky. So that NAV was down almost 10% since June, and obviously it's down 41% since September 21. A lot of that, the big drop since last year was Klarna, but within this last quarter, they've written up 2 of their holdings, Deep Sticks and Featurespace, and maybe say a little bit about them in a second. And they've written down 3 positions, so Starling, Graphcore, and InfoSum. I think that really all relates to declines in the comparable values of those. They've still got cash, and remember the big story that we were talking about before was how much cash have they got, and can they use that to fund these companies through to a position where they're profitable and they don't actually need more funding. So there's at the end of November, at 17th November, rather, 67 million of cash, 13 million in Wise, which they have been selling down anyway, and they could tend to cash if they needed to. They also, since then, sold out of their stake in Revolution Beauty for £5 million, which is probably not a bad result considering that I think the state that the thing's in. They did say, actually, in the Capital Markets Day, if it turns out this being some kind of fraud or something there, they will take action, whatever that means. I don't know whether there'll be anything to go after. But nevertheless, the sale of Revolution Beauty, because that was valued at 0 at the end of September, adds about 0.8p to that NAV. And then in terms of this sort of funding position, as they say there, there's a breakdown. I actually got another chart I'll show you in a second. But the foreseeable likely future funding requirement is about £20 million, all right, relative to this money that they've got there. So it's obviously a difference. This is what the portfolio looked like at the end of September. So the big position now is WeFox. It was Klarna. Klarna was the biggest by far, and that slashing net valuation reduced it down to about 6% now. On the Capital Markets Day, we heard from WeFox and Brandtech, Smart Pension, Deep Instinct, Featurespace. So really quite a chunk of the portfolio. And actually, it all sounds like it's all going in the right direction. It all sounds quite exciting. We just have to wait and see with all of these things. It's one of these sort of open-ended things, whether they actually succeed or not. Probably of the ones that are closest to actually getting somewhere, Starling seems to be doing okay. The reason the valuation has been coming down is because they kind of shifted it to what's the value of equivalent bank, and banks, as we know, have been dropping in value. And that's really because people are worried about defaults, and we'll just have to wait and see how that turns out for them. Brandtech, which used to be called You, Mr. Jones, is a kind of digital advertising business. They seem to sort of be a hint that might be looking to IPO, but not immediately. I think we're talking about second or third quarter of next year at the earliest, probably. But nevertheless, that could be the one that is the most likely next exit, if you like. I'll show you that again on the screen. So this is a sort of better breakdown of where we are with the state of the funding thing. So things that are already profitable, things that are funded through to where they can see them being profitable. Those where they're pretty sure they've got enough cash to last them for the next 2 years. and then 19% where they think they might need to put some more money behind them. And I said that they think that might be about 20 million quid. So that does leave a gap there. And I was sitting next to, it's just the people I know from years back, but they were all moaning that why aren't they doing buybacks? The managers are quite adamant that they can make more money by backing the existing portfolio than they can do from buying back shares at this level. I think there's a lot of people that necessarily agree with that, but that is nevertheless, that's the stance at the moment. And then the shares price will be going up anyway. They put this chart up, and I think it is interesting because basically what they're saying is you've got the shares, and this is when I think they were 72p-ish when they did this. So they're on a 51% discount. And then if you knock the liquidity off that, because eventually you can just hand that straight back, and they're not going to do that, but you could, then that's equivalent to a 61% discount on the underlying portfolio. They're saying if they sold off one of the assets, one of the large ones, you could say turn that into cash and hand that back. I mean, again, they're not going to necessarily hand that back. You could say it's on a 73% discount, the rest of the portfolio, and 85% if you could sell two of these things. Well, so that's all the theory. So basically, they keep ramming home the point that this thing they think they're convinced is way too cheap. And these are the assets that they're talking about that they consider to be late stage, that maybe sort of ripe for turning into cash at some point. But all of them, they think they're worth a lot more money than they've got in the value of that in the NAV in terms of where they would want to sell them for. So that is probably worth bearing in mind too. I do think that this is the key to getting this thing re-rated, is that they need to sell something. And then do something with that cash to narrow the discount. They've said that they've been approached for slices, I think, not whole positions of some of these companies at a premium to the NAV that they've got them at in the in that post-September NAV, even up to sort of like a 15% premium. Again, I think investors just need to see something concrete that they can actually hang their hats on to believe things. But I'm going to look more about valuation process and maybe talk about that in my CTO article this week. You need to look out for that. The other big thing, obviously, is the performance fee. So that caused a lot of upset when they paid it last time, and the board promised to revise it, and they've now done that. It's still on unrealized gains, and I think this is, to me, the crucial problem with it, because in the private equity world, that's not the way things normally work, and you get a performance fee based on realized profits, and obviously the unrealized NAV went shooting up, hit £2.53. They took an enormous performance fee out of it. What they have obviously said, and there's no way they could have not done this, but they are maintaining the high watermark at £2.53. So the NAV has to get through £2.53 before it starts accruing again. There's no chance of them earning anything before that. And they have cut the fee as well. So the way that they've done it is basically they've cut it from 20% of excess profits to 12.5%. And the managers are going to get all of that. So Jupiter doesn't get anything. I think it's interesting that Jupiter have agreed to do that, but there we go. The fee will be paid in shares, and shares based on what the NAV is. I mean, assuming that it's still trading at discount. So that sort of reduces it again. And they won't get all of it straight away. So there will be a sort of deferral and a possible clawback. And I think, again, that's a big good tick in the box. And there's also a cap on the total expense ratio for any year. Shareholders need to approve this. And I think this is going to be the big test of attitudes towards the company now. So they'll be publishing a circular shortly, and then we'll see whether shareholders say, yes, they get that or not. There's a couple of questions here coming in. So Of that 20% before, we don't know how much the managers got. Actually, that's not true. I can probably go back and work it out. It definitely wasn't all of it. And it might have been half, to answer that question. So I think, yes, the performance fee, it's all good. It's all going in the right direction. But as I say, I'm still not entirely happy that it's on unrealized gains. And maybe I don't know what the way around that is, but I would have thought that's may still be the sticking point. And brand tech, I think that the question here is about the timing of the IPO. Basically, what Richard Watts is saying is that he thinks it's conceivable that the markets settle down and IPOs are doable again by the time we get through to the second or third quarter of next year. I'm kind of agreeing with you. I think that's kind of the earliest it's going to happen, but I do think all these things move in cycles, and we will get back there again, whether it's on the same sort of hype and excitement that we had a year ago. I very much doubt that, but nevertheless, does seem to be an attractive business earning decent profits, and definitely the sort of thing that probably could IPO. And to answer Tim's question, it definitely varies from company to company as to how much Chrysalis holds in these things. It's not really in a position to mandate that they IPO or sell or do anything. I don't think that's not what they want to do that anyway. I think it's all of this stuff is done as a kind of partnership with these businesses. So it happens when the management are happy that it's going to happen. But nevertheless, everybody is working towards the same idea. They need to crystallize value at some point. Cool. Let's move on. Otherwise, we'll be here all day. Syncona, again, just quickly. This is same three-year kind of chart, but you can see the NAV here has been much flatter. It's now actually 10 years old, and obviously it's doubled its money, which is good, but it hasn't seen an awful lot of excitement in the last year. And as we know, biotech's been quite heavily out of favour. It's been in and out returning a discount, but it's actually a discount is there now, but it's not enormous. So the NAV has actually gone up over this last 6 months, or the 6 months to the end of September, but that was driven by foreign exchange movements and not by the value of the underlying portfolio, which I suppose is slightly disappointing. Obviously, the listed holdings are going the wrong way, and this just comes back to, if you read the IPO note that we've written on Conviction Life Sciences, it all relates to that. And basically, listed biotech is probably cheap. They have made a new commitment to Cosmalia, but it's only £60 million, and this is a much bigger fund than that, so about sort of 1.3, 1.4 billion. So probably only about 1%. They've also, and I think this is interesting, they've done a take private bid, and that seems to have succeeded. So that's probably a tick in the box in terms of getting some money deployed. But they're trying to ramp up the number of companies that they back. So the aim is to back 3 new companies a year. All the way through, they've had really big liquidity position. So if you look at the position now at the end of September, the portfolio was valued at 600 million. They had cash and liquid investments of 763. It's always been like that. So it's enormous cash drag. And I'm now starting to suspect, it all made sense at the beginning in theory, because they were saying, we need to be able to back these companies to a position where they can be self-funding or where they can be sold. And we need to be able to stump up money if it turns out that other investors aren't able to. So I think we've just been through a period where biotech, as I say, has been a bit unloved, and they haven't really had to call on that. So to my mind, I think they could run that down quite a lot and still run the fund quite effectively. Putting that money to work would be enormously helpful. The other thing that I'm a bit sort of uneasy about is that they've just said they're going to remove the cap on the total expense ratio. and it was capped at 1.05% of NAV. And they are saying it might start to go through that soon because they've been hiring people and they need to put up salaries because of inflation. All well and good, but we are talking about still a portfolio where you've only invested 600 million of it. So that the TER on that portfolio is more than double that. I'm just starting to feel a little bit uncomfortable about that, to be honest. I think that maybe somebody needs to rein those expenses in a bit. There is hope that they will get further NAV uplifts next year. So that they've got 12 things that they're looking at, 24 milestones in 2023 in the portfolio. That is potentially good news in all sorts of things. And, you know, I do love what they're doing. I think the whole concept of it is a great thing. This is the company that they've just acquired. And I think this just speaks to what I was just saying about how cheap biotech is. So that thing is down 97% since it IPO'd. And they've just snapped it up here. They are paying 34 cents up front and an additional 73 cents if they meet some certain milestones. And it's another kind of retinal eye disease, genetic eye disease problem that they're trying to tackle here. They've already had 2 big wins in this area with Nightstar and Gyroscope. Could be quite exciting, but it's interesting that they've been able to acquire it for as little as they have done, considering how much that company was valued at back in the day. Enough from me. Let's, well, I just mentioned Neogen very quickly. This is another investment they just sold, but this is not going to move the dial, as I say here. They've only had it for a couple of years, and at the moment they've just sold it for a little bit more than they bought it for. But there is hope they can get a bit of an upside if it meets certain milestones. Anyway, I've rattled on too long. Let's talk to Andrew.
Brilliant. Thanks very much, James. Let me just switch over to my screen and we'll talk about what's been going on this month. There's been a decent smattering of gains. Overall, the sector was up about 2.5% or 3% over the month, so reasonable gains, and a number here over 15%. I think the notable ones are the 4 China trusts, which I think is quite interesting. You know, I think if you were looking at the media headlines, you would have assumed that these would have been in negative territory this month. And that's just a warning that actually what's going on under the surface is often very different from what you perceive from the top. And I think the other notable one is Chrysalis, which I suspected James might talk about, so I won't flesh it out anymore. The performance fee change is especially notable, I think, in terms of the sentiment surrounding this trust, because I think that was a really significant factor that bothered a lot of investors. And it's a classic case of bolting the stable door after the horse has bolted. But the performance fee was 117 million in that 1 year, and the managers received 60 million of that, so it was about half. And clearly that wasn't going to be acceptable going forward. So dealing with that, I think, was a very big factor in potentially turning sentiment around here. And Chrysalis is the first really of the growth trusts that have been so hurt by the higher interest rate environment to have started to rally. So yeah, it'll be interesting to see if this is the first cuckoo of the spring or not. But it's encouraging anyway that we've seen a bit of a rise there. Amongst the fallers, the obvious one at the top is Home REIT, which has obviously been targeted by the short seller Viceroy Research and has rebutted those allegations, but seemingly not tremendously successfully. And I think we saw with Civitas before that, you know, where this mud is thrown, a little bit of it does stick, and it's quite hard to remove the stain. It does take a while. even if the allegations prove not to be true on the whole. So it's had a tough month anyway, home REIT. And it's not the only REIT to have struggled. There's another block of them there in the purple, which have all declined again this month. You know, REITs are still adjusting, I think, to this high interest rate environment, which is obviously increasing the yields on property and therefore reducing the prices. And I've also highlighted RTW Venture, Taylor Maritime, and Pollen Street, because I have talked quite a lot over recent months about both China and REITs. I won't go over those again. So I'm going to talk about valuations and how those have shifted instead, which is why those three trusts come into play. So I'll talk about 5 investment trusts where I think the valuations have shifted and look quite interesting now. My sense is that because the market is wrestling with this transition to higher interest rates and what might now happen to the economy and its rebound from the pandemic, there's a lot of information to process, and I think this can lead to anomalies where things are overlooked or mispriced. So it's an interesting time to be an investor and to make sure you're keeping an eye on the discounts and premiums in the market. So beginning with one that I think is quite expensive, and this is measured by a Z-score. And if you're not familiar with that, that's a measure of the number of standard deviations the rating is away from its mean, in this case, over 12 months. So the bigger the Z-score, the bigger the divergence. And one that stands out to me as being relatively expensive at this time is Vietnam Enterprise Investments, which is the largest of the 3 Vietnamese specialists on the market. It's on an 8% discount at the moment, which compares to its 12-month average of 17.5. I think this is quite surprising because the NAV has been so weak over the last 6 months. It's been a tricky time for the Vietnam market. And the NAV here is down by more than a quarter over that time, which means this is one of the worst performing investment companies over the last 6 months. And therefore, it's quite surprising that the discount appears to have halved over that period. So that's quite an interesting one that I think I would probably avoid at the moment. And I think the same is true to a lesser extent for the other 2 Vietnam trusts as well. So they're not looking like bargains to me just now. On the converse now, I mean, but the trusts that I think are looking relatively cheap. One that does jump out to me is Aberdeen Property Income. And this has been a pretty good performer, actually, over a long period of time. I've spoken to the manager, Jason Bagley, a few times. He's a very experienced manager, has done a very good job with the trust. And he pointed out to me that the trust has been a very early adopter of some of the really important shifts, actually, in this sector. So it was, I think, the first, actually, of its type to convert to a REIT in 2014. It reduced its retail exposure early. And it's been buying land in Scotland recently to make sure it has carbon credits available to it for the future. So I think it's quite a dynamic trust that's done a good job. It has had 1 or 2 small elements lately that haven't been great. Obviously, its NAV is falling at the moment, in common with most of these UK commercial property trusts. And there was one deal it did where the outcome wasn't quite as good as expected, as investors were hoping. But on the whole, it's been very good. And you'll see this table here of UK commercial property trusts is ranked by the 5-year NAV return. And Aberdeen Property comes in 3rd over that period. The top 2, AEW UK REIT and LXI, have both been recognised in the annual investment trust awards that have just been around. Aberdeen Property is just under that, but it's in 3rd place, so it's a pretty good trust. And yet it's now on a 47.8% discount with a 7.3% yield, which is it's a little bit hard to read, but it is the highest in this sector. And you can see there's this widening out here. The NAV is starting to come off now, and I think we would have to expect it to come down a bit more. But nevertheless, I think the fall off in the share price has been quite dramatic. And if you're a patient investor willing to take that yield for a while, you might find that that's an opportunity. The next one is Pollen Street, which is a bit of a curious one. This used to be the Honeycomb Investment Trust, and it earlier in the year decided to buy its management company, Pollen Street, and change its name. Importantly, it was reducing its dividend as part of that strategy, which was down. It was 80 pence per share beforehand, and it was a very good debt trust that seemed to be very reliable, producing a nice cash flow and dividend flow, and it was a very high yielding trust. It is reducing that dividend down to 51 pence a share. And I think quite a number of holders who were very satisfied with the previous debt trust were not too pleased with that. And so they have sold it off. And here the discount has widened out to 36% against its 12-month average of 14. And the yield is up to 7.8. You can see this rather curious progression of the NAV here. I'll just explain that. Basically, the little drops you see here, that's it paying its dividend. And then the NAV rises again, and then it pays its dividend. So effectively, the NAV is quite flat, but you've seen a big sell-off in the shares because they're out of favor. And I think there were definitely some sellers there who just didn't really like it buying the management company, which I think has increased the risk. So that is one element, but I think it's being very well priced. The shares have just gone ex-dividend yesterday. So if you do buy them now, you won't get the latest one. Next up is RTW Venture, a growth trust. This is at the venture capital end of US biotech. So very much at the sharp end of the reduction in valuations. It was premium rated for quite some time. I think the managers are highly thought of and had a very good track record until this recent period. But the discount now has ballooned out to almost 30% compared to its yearly average of 10.3. I do follow this one quite closely. I hold it myself. And its largest holding, Rocket Pharmaceuticals, is a listed company on the NASDAQ, so you can follow that. And that hit its trough in May and has since doubled. And so, and the managers as well, I've spoken to them, they do feel that the sector has hit its bottom in the US. I mean, we'll wait and see whether that's true or not. But again, I think if you are perhaps dribbling a little bit of money back into growth stocks, then this might be one to think about. One other factor there is that clearly it is a US-based trust denominated in dollars, although you can buy some sterling shares if you like. And I think if we'd been looking at this about 6 weeks ago, when sterling was really incredibly weak against the dollar, you would be thinking you were taking on a lot of currency risk at that point by buying in dollars. I think now at 120, that's less the case. So I feel a bit happier now buying things in dollars than I did a few weeks ago. So again, I think there's no problem with that. The final one is Taylor Maritime Investments, the shipping leasing company, where the discount again has widened out very considerably to 37% compared to its 12-month average of 17.5. To some degree, I think this is the sector just moderating, having been very much in fashion at the start of the year when shipping rates were shooting up. And I think that they've settled down to some degree now. But there is a special factor here as well, which is that Taylor Maritime is making quite a chunky acquisition of Grindrod Shipping. And I think that probably unnerved a few shareholders, and also it may take a little while to digest, and obviously there's borrowings involved. So I think that's probably the primary reason for the derating here, along with just continuing concerns over China and the implications for world trade. But I think the same applies here as for the case with the Aberdeen Property Income Trust and also Pollen Street, that if you are prepared to buy in now and maybe just sit tight for a while, you can obtain a very nice yield while you wait. In this case, it's 7.2%. So I think if you keep an eye on the ratings, there's quite a lot of opportunity about at the moment. All right, I can see James has been very carefully answering the questions, so thank you, and I'll hand back to you now.
Thanks very much, Andrew.